Join hosts Mary Carter and Stephen Ross as they sit down with Senior Loan Officer Jordan Cordero from Live Oak Bank for a candid deep dive into contractor financing, what it really takes to fund growth without starving your business of cash. We'll cover what lenders look for in underwriting common deal killers and how to think about rates, terms, and working capital without getting trapped in expensive short-term money. Let's get started.
Welcome back to HVAC Full Blast. I'm Mary Carter.
I'm Stephen Ross.
And we're excited to welcome another guest on today. I don't know, we have to maybe get a scoreboard going of your friends versus my friends. This might be, actually, I'm thinking this might be your friend. I think you threw out the invite.
I'm just older than you is what it comes down to. So I've met more people. That's it. That's all it is. But yeah, I'm excited to have Jordan on today for sure.
Yeah, so today we have Jordan Cordero. Jordan, welcome to the podcast.
Appreciate it. I'm excited to be here. Thank you all for having me.
Absolutely. And Jordan is a senior loan officer for Live Oak Bank, and he's on the service contractor team. So first question right off the bat, why are we talking to a bank? This is we've done a couple like different types of financing episodes, but this one's got a little unique flavor to it.
Yeah, I think here's my introduction to heating and air is, I was a sales guy for a few years and then had the opportunity to buy part of a company. And so going from just on the front end sales, like all I really care about top line revenue and maybe gross margins, right? That's really all a sales guy cares about. To all of a sudden trying to figure out EBITDA, net profit, and almost more importantly than all of the above is just cash flow. I mean, there's years where we were showing 6, 8, 10% profit, but like we didn't have any money in the bank. And so all of a sudden, as a business owner, I've got to learn, like there's more to this thing than just selling heating and air to make a successful business. So I'm excited to have Jordan on because what I really want to, what I'd like to talk through are just some of the scenarios that business owners run through and just pick your brain a little bit and go, hey, what are some ideas on how to handle these? But Jordan, how long have you been doing this?
I've been at Live Oak for about 10 years now. We started doing business loans for the service contracting space, mainly with a heating and air and plumbing focus in 2019. And I've been doing these types of loans for contractors ever since.
Nice.
That's awesome. So you could almost say that you're like live and well, Oak. 10 years.
Yeah, I'm certainly not the guy to go and turn a wrench or fix a heating and air unit, but I can tell you how to get a loan for a business like that.
Excellent. Yeah. So, and that's really interesting because when we think about loans or again, like usually in the financing conversation, we're always talking about how we can offer our homeowners financing options. But why might a contractor be seeking a loan? In theory, shouldn't they just have all the funds that they're making from selling these systems to keep the thing moving?
Yeah, they should. But sometimes there's a bigger play behind that. But that is a common misconception whenever people think about financing solutions. It's the consumer financing companies that you're offering to your homeowner whenever you go and replace a unit. But there is a different side to the financing piece geared specifically to the business owner or the dealer who's looking to grow, because obviously we've seen a lot of consolidation going on, and folks in the service contracting space are thinking about, how can I get involved? How can I grow my business through acquisition? How can I help or sell out to my family member or internal employee? And there's a solution for that. And that's the side that a lot of people don't realize is there is an option for it. So a lot of contractors are coming to us for a loan to buy another company. Maybe they've got a competitor that wants to sell for 500 grand or $1 million, and they don't want to fork out that money. They'd rather take out a loan to do that. We have folks that are coming to us all the time for something like that, buying a building to run their business out of, dealers who are looking to retire and want to sell out to their GM or their family member. Folks are using a business loan for things like that.
Let's start right there, because I think that's a good kind of entry to our conversation. Is, let's say I own a heating and air company and I want to sell it to a family member or one of my kids, or maybe one of the employees wants to step up and buy it. You start out maybe with just kind of a conversation. What is the SBA? How does that work? But I think, is that your primary go-to for that kind of loan?
Yeah, absolutely. So we use and a lot of lenders in this specific space, if they're doing a loan for a service contracting type business, they're going to lean towards the SBA program. And what the SBA stands for is Small Business Administration. And a lot of people started hearing about that or that this SBA whenever the PPP loans started going around. You guys remember that?
Oh yeah.
Whenever
Oh
contractors
yeah.
were scrambling with all the uncertainty. So the SBA implemented the PPP loan program so that folks could get working capital to keep their folks around. Well, that was a temporary thing. The SBA program also has what's called a 7A loan, and that loan program has been around since the 1950s. So it's the SBA's flagship lending program. But where it really benefits folks in our industry is that the SBA program essentially gives a bank an insurance policy whenever they do a loan for the purchase of a business. So, for example, a lot of the value in these heating and air companies is within the goodwill, customer list, the financials, employee base, things like that, and not necessarily hard assets that you could secure a loan with. So when a heating and air company goes to their traditional bank and says, "Hey, I need $1 million loan to buy another company," the first thing that traditional bank says is, "Okay, you have $1 million in collateral that I can take a lien on, so that if you stop paying me, I can sell that and get my money back."
Mm-hmm.
Right.
A lot of times the answer is no. So the traditional bank pushes that option away, where the SBA says, "Hey, if you get $1 million SBA loan to buy that heating and air company, and the bank adheres to all the SBA rules and regulations, then they'll guarantee 75% of that loan." So right off the bat, that risk to the bank goes from $1 million if it was a traditional loan down to only 250. So it gives a bank a lot more comfort doing that type of deal for a solid business, even if they don't have that collateral to sell in the event that something goes bad.
Is that
Gotcha.
the typical percentage that 75% of the loan is covered by this program product?
Yep,
Okay.
it is.
Interesting.
Mhm.
That's really well said and very clear, because I think that's a misconception as well in the industry that I have a company, I'm pulling in a good net gross profit, I'm profitable, right? I'm paying employees. But then where is the collateral to back up what I want to do next, whether that be grow, acquire, succession plan? That's and we talk about the fact that customer lists become very valuable and maintenance agreements, but then how do you go to an institution and prove that worth,
Yeah,
right?
right.
That's it sounds like it's nearly impossible unless you have one of these kind of vehicles to do it.
It is. It's really tough. I would say a lot of people in our space, it's really tough to access business financing without that program, because like a lot of people have all their net worth built up in their company. Like maybe they own a house, maybe they have some cash, but they probably don't have $1 million in cash to pledge to a bank, so that if it starts to go bad, the bank has something to fall back on. So that SBA program, it gives folks access to capital who probably didn't have it through the traditional route, which is great.
So let's say I'm going to go buy a business. There's a couple different options. Maybe walk it through. One is you're just buying the business. One is you're buying the business plus the real estate. I mean, just in a couple seconds, what's the difference between all those? And then part B to that, I'm going to ask you about interest rates. But let's just start with like the different types of loans out there.
Yeah. So with the SBA 7A program, again, this program was built specifically to get capital into the hands of small business owners. And so with this program, some common uses for that are folks who want to buy another company. So you want to grow your business and you want to buy the competitor who's looking to sell. You can get an SBA loan for that. Commercial real estate. If you're an existing dealer and you're renting a location and you decide it's time for me to buy a building, SBA loan's a good option. Working capital to grow into a new service area, invest in a marketing plan, buy some trucks, get an SBA loan for that too. And then there's also a piece of the SBA program for debt consolidation. So you can look at getting an SBA loan if you want to combine vehicle loans into one payment or things like that. I always like to say with the SBA program, the biggest benefit to this program for an existing dealer Somebody who owns a business can show they've been in business for 12 months. If you're buying and growing through acquisition and you're acquiring a company in a similar service area to you, you have the opportunity to get up to 100% financing on that. So if you're operating and call it San Diego and you want to buy another business in Los Angeles and you want $1 million to do that, you might not have to put any money into that deal, which is very lucrative because it lets contractors keep the money in their bank account to help with seasonality or invest it back into marketing or buying trucks. So that's a big benefit to the SBA program for existing dealers too.
And that's specifically for expansion in a new market?
Expansion in a new market, or if you're buying a similar business in the same market too.
Okay. Wow. That's really interesting. I don't even think I knew about that extra gear in there.
Yep. Or if you're buying a building, you can get 100% financing on that as an existing dealer too.
Yeah, I'm glad we're talking about that because again, within the realm of entrepreneurship, small business ownership, these are just things that are bad assumptions that maybe me working for a manufacturer that I make. Like all my dealers have a building, they're good. Like it's like that's not always the case.
If it was, I mean, everyone would be in a great position, but it's not.
Yeah.
And then I think there was a wrinkle. So I'll give you a scenario, Mary, where this played out. So we owned a heating and air company. We added plumbing, but we wanted to add electrical. So we went out and found an electrical business for sale. And the value, it was a small company. So the value of that business was about $250,000. If we just borrowed $250,000 under the SBA rules, I think we had 5 years to pay it back. So with interest, roughly $60,000 a year, but they were in a building that was worth $150,000. So if we borrowed 400 grand and we bought the business and the building, we could stretch out payments over 10 years, which saved us roughly $10,000 a year. And then we just sold the building a year later, put that towards the loan, but we still had the lower payment. So there were some rules in there where it pays to have somebody who knows the SBA program to go, hey, let's think through a couple different scenarios because that monthly payment versus the monthly payment with the building included was a huge difference, 10 grand a year.
Yeah.
And so that, I mean, part of the issue is growing the company, top line revenue, net worth, but like cash flow that's where you get your butt kicked, I feel like. And so anything you can do to improve cash flow is enormous.
Yeah, that's actually a great point because essentially whenever you're getting an SBA 7A loan, you can use that product to buy both the business from your competitor and the building. And most of the time what happens is the SBA can stretch just a building purchase out to 25 years. So what typically happens is that the SBA will look at, okay, what portion of the loan proceeds are going towards the business and what portion of the loan proceeds is going towards the real estate. And they'll look at a blended term on that. So so your example, if you're getting a 5 to 10 year term, 5 to 10 year term on the business and you got that real estate, well, now it goes from a 10-year term out to a 17-year term or out to an 18-year term, which like you said, you stretch it out longer, your payments less. So that's a good point too.
And then we just turned around and sold the building. And of course, the rules are then that the equity from the building's got to go to the loan, but we didn't care. We just wanted the longer payment term to get it down.
Yep.
Yeah.
What do you think? I mean, if we just talk about working capital, so let's say I own a heating and air company. There's a couple, you mentioned real estate was one. I need to expand. Can you use an SBA loan to build on your existing land?
Yeah, you can use that or you can use the same program for that.
Okay.
You own a piece of land and you want to build an office and a shop, you can do that. And you have up to, with the SBA loan program, you have up to $5 million worth of SBA runway. So I always say small business. I put small business in quotes because there's some large companies that are using this program. I mean, we've dealt with anything from the $500,000 in revenue company up to the $60 million revenue company that are all using this program.
Yeah, nice. What do you think I mean, if you're just looking at working capital, across the loans that you've done in the last couple of years, what's the number one thing that heating and air companies are doing with that working capital?
That's a great question. So I would lump that into two separate categories because I think these are both similar. The first one is we see a lot of folks taking out working capital to start a new type of service. So heating and air company that decides they want to start adding plumbing to their service offering. And with that, you've got to hire a couple plumbers, buy some equipment, maybe invest in some sort of marketing plan to your existing customer base that says, hey, we're not only your heating and air guy now, we can do your plumbing work too. So we see people taking out $200,000 in working capital just so they have that to do that. And then on the other side, what we see is a lot of folks are looking to grow, and maybe they've looked for a business to buy. Maybe they can't find the right company. Maybe they can't find one that they see is worth it. So instead of acquiring a company in like a neighboring service area, what they'll do is they'll take out working capital to just expand their business into that. So maybe they'll lease a small location, buy a couple trucks, hire a couple new folks, and they'll invest in a marketing plan there so that they can get that specific location off the ground, and they'll take out that working capital to do it. But what most folks find out is that they typically don't even need the full amount that they take out. So with the SBA program, if you've got a working capital loan and you decide you don't need the money that you got, you can turn around and pay it back with no prepayment penalties. You can pay that thing off at any time. The folks are doing it to kind of give them a little bit of a cushion in the event that they do need it. But if they find out that they don't, they're turning around and just paying it off so they don't have that loan payment anymore.
That's really nice. Prepayment penalties are a nasty
Yep.
extra line item in the contract language. So we love to avoid those.
Yeah. Any loan term that's less than 15 years with the SBA, no prepayment penalties ever. If you're buying just a building that's stretched out for over that 15-year term, there is a small 3-year prepayment penalty. Typically 5% year 1, 3% year 2, 1% year 3. But after that, pay it off as quick as you want, go and refinance it, do whatever you want to after year 3 with no penalty.
Okay. And that makes some sense to me, just a little bit with what I know from banking, because the bank is banking. I just said bank 3 times in one sentence, so watch out. But the bank is planning on earning on some interest. So if you pay it off early, then they lose that opportunity, and then therefore the penalty, right?
Exactly.
That makes sense. Banks are not evil, but they are very smart.
They're definitely trying to make money somewhere. And I think the biggest misconception too with the SBA is that a lot of people, whenever you get one of these, they think it's the same as a traditional loan, where your traditional lender probably charges you an origination fee on the loan. Like if you go and get a mortgage, maybe it's 1% of the loan balance and the bank keeps that. With the SBA loan, we don't charge, there's no origination fees that the bank makes for processing that loan. They strictly get their money off of interest income on the back end. Like whenever you're going to get an SBA loan, there are specific SBA fees that are rolled into that are paid directly to the SBA. But as far as what the bank's actually getting, they're just making money on the interest on the back end.
Interesting. Gotcha. So let's talk about interest rates for a second. So, if I said, hey, I want to borrow some money, but I got equity in my house, I can go get a HELOC. And I think today's rates on HELOCs are somewhere 6.5%, 7%. If I've got like an unsecured line of credit or a credit card, I'm paying 18 to 20%. So if that's maybe the spectrum of interest rates today, where do SBA loans fall in? Are they fixed rate loans? Is it variable? Give us kind of how does all that work?
Yeah, so I would say there's a long-winded answer to that. I want to keep it short. I don't want to take up the next 30 minutes. So interest rates for the SBA loan, it's going to differ based on the type of product that you're getting. If you're getting a real estate loan and a bank has some collateral to fall back on if the deal goes bad, it's priced a little bit different than the Goodwill loan where all they have is the SBA insurance policy. So I would say for business acquisition, something that's Goodwill, working capital, debt refinance, where a bank doesn't have a ton of collateral on, what I'm seeing right now is the prime rate's at 6.75. Typically seeing about a 2% to 3% spread on that. But it depends on loan size. So call it right now, 875 to 975, somewhere in there. But it could range based on what the full profile looks like. And then the second part of your question, variable, fixed, those things. You do have an option for a variable 3 or a 5-year fixed rate option. We're in an interest rate environment where a lot of folks are opting into the variable rate because we think we're in a decreasing rate environment. But any lender can quote you based on variable 3-year fixed or 5-year fixed. We see a lot of variable on business goodwill purchases. So business acquisitions, they're oftentimes 99% of the time price variable because there's risk associated with that type of deal. But on the real estate side, a bank can get a little bit more aggressive because they do have something to fall back on in the situation. So you see more 3-5-year fixed rates on things like that.
And I think when we bought that electrical company, that was the other advantage of rolling the real estate in, is we could fix the rate for a few years. So that was a big deal. I mean, you just never know. So yeah.
It's very interesting. Oh,
there you go, honey.
Did you catch that?
That was terrible. Love it. Jordan, one thing you should know about Mary is she gets really excited when we talk about money. I mean,
I really do.
So the pun.
Me and Mary just became friends.
There you go.
My horoscope is a Cancer crab, and if you know anything about a Cancer crab, is they just like to pinch onto that money. So that's me.
Let's talk about underwriting. So, underwriting, I think, is just a funny thing, because you and I talked about this right as we were starting the podcast. But you got your CPA. Your CPA is like, hey, let's get your taxable income as low as possible, right? Which makes a lot of sense. We had another guest on a few weeks ago. We were talking about valuations, and what he said was, well, wait a minute, like your valuation is going to be based partially on the profitability of the company. So if the profit goes away, the worth of the company goes down. How does that affect underwriting? Like, I mean, at least maybe when you're doing a valuation, you can say, well, here's the business owner's personal expenses that he ran through the business and roll those back in. But does bank underwriting let you do that the same way? How's that work?
Yeah, it's a good question. Like you said, a lot of the value within these companies is it's within the cash flow, within the goodwill, things like that. So we look at it the same way. We're looking at cash flow of a business to repay a loan that we're giving to somebody. So whenever somebody approaches us for a loan, if you're saying, hey, Jordan, I want $500,000 in working capital to grow into this new service area. First thing that I say as a lender, and as what our underwriters would say is, okay, well, show me your historical cash flow. So show me your last tax return, show me your year-to-date profit and loss statement. And I'm going to look at the numbers and say, is your business able to support the loan that I would be giving you? And if it can't, then it's really tough to get an approval with the SBA for that. Now, to answer your question, there are certain add backs that a lender or an underwriter can look into. But if you're approaching a bank as a business owner, you really want to make sure you're showing the cleanest picture, because you don't want to have to get an underwriter that's having to pick through a bunch of different add backs, having to pick through like what's actually a business expense versus what's a personal expense. It can really lengthen the process and make it more difficult for an approval. So I always say is first step in the process is make sure you're organizing your financials. There are standard add backs that stick out on a tax return like a sore thumb that an underwriter can pick through very easily, but try to limit the personal expenses being ran through the business. Like a big one we see is personal vehicle expense. People are like, hey, Jordan, I got $30,000 in gas that I've used for my personal vehicles. Well, how can I break out what's personal and what's business related for a service-based business that's running 10 trucks a day? It's really tough to sort through. So yeah, it's I always recommend make sure your financials show what your business is truly doing if you're trying to approach a bank for financing.
What is the best way to break that out? I think that you bring up a really practical problem there. Like, is it to just keep a weekly log? I'm just thinking as you scale, that could be daunting for a larger company.
Yeah, we see it in a couple different ways. It's depending on the size of your company. You probably have a CPA or somebody that's doing a deep dive on the financials, making sure your general ledger's appropriate, things like that. But it's tough. And which is why it's tough as a lender for me to say, well, where are these being expensed from? Is it actually personal versus business? So there's not really a hard and fast rule on how to do it. What we try to do is we try to look at everything conservatively, and we say, hey, can the business make this loan payment that I'm giving them without these add backs? Just because if they're telling us they can add it back, then okay, that's only a benefit if we look at it conservatively. But if we have to get a little bit deeper, if our underwriting team needs to dig in a little more and needs to include some add backs, then we can start looking at it at that time. But we always use that as a last case scenario. We want to try to make it work without these add backs that we're claiming.
Stephen, do you have any pro tips on how you used to do it? Do you know what you did? Just good old tracking?
I mean, our general rule of thumb, I mean, if I was going to Home Depot and I was going to buy $100 worth of supplies for my house, I could run that through the business. I could just pull out my business credit card and charge that as a business expense. And the IRS is never going to know. And it maybe saves me $30 in taxes, right? But what it costs me, I mean, if I was going to get 10x my EBITDA on my profitability, like what I just cost myself was $1,000 on the valuation of my business. So I saved $30 in taxes, but it cost me $1,000. And one of the things we found too was when it comes to loan underwriting, I mean, just like everything else, the bank is going to adjust the interest rate based on risk. So if you're running a risky business, that interest rate is going to be higher. If you're running a fairly conservative financial business where you're like, hey, our cash flow is pretty good, you're going to get lower interest rates. So again, like running those personal expenses through the business, if it costs you in terms of a higher interest rate on the loan you're trying to get, well, that probably ate up, most of what you were getting in tax savings. So I think it was just, for my business partner, Tim and I, we just kind of decided, hey, we're really not going to run personal expenses through the business. I mean, we both had vehicles through the business. Our cell phones were through the business. I mean, we had some standard things like that, but like we weren't running a boat through the business or anything like that. I mean, we were pretty conservative, and I think it paid off for us in the long run.
Yeah, sounds like at the end of the day, best practice is, to do the best practices, right?
Yeah.
Yeah.
It is. It's tempting. Yeah.
I love that point you made about you pay $100, save $30, how it affects your valuation. I think I love that point, because if you put it on a bit of a bigger scale, if you say, hey, I'm running $100,000 of personal expenses through this business, and you're saving, call it 30%, you're saving 30 grand. We're seeing right now, depending on the size of your company, call it about a 4 times multiple on that. If you get to be larger, then the private equity groups are paying for you more. But if we're talking about what most folks are selling, that's about 4 times. So you saved, by writing that off, you saved 30 grand in taxes on what could have been 400K in value. Yeah. That's a great way to put it too, and puts it in perspective as well.
And it's hard to quantify the interest rate difference, right? I mean, like, hey, I could have borrowed this money at 8%, but now I'm paying 9.5%. I mean, you could probably come up with some way to figure out what it costs you there too. But in the long run, it just seemed like we just kept our personal expenses separate for the most part. What are some other things? I mean, again, I think underwriting, I'll share with you I had a little bit of a horror story, which is I was buying a house last year and the underwriter came back and here we were being fairly fiscally conservative, but the underwriter comes back and says, well, your company's not profitable enough for us to count the income coming out of the business towards your debt to income ratio for your mortgage, right? Like I'm going to go it's just a regular mortgage. And so at the last minute, I had to scramble like crazy to pay down debt, to get my debt to income ratio where they wanted it based off of a small portion of my income because they weren't letting me count most of my income. And then literally a week later, we sold the heating and air company for a pretty good multiple. And I sent the offer letter on the heating and air company to the mortgage underwriter just to prove a point, to say, hey, man, I don't think you have a clue what you're doing for your job. Like, just my personal opinion, but I think you suck. But the point was, anytime you go through underwriting, whether it's a personal loan, business loan, like that cash flow. I mean, it's one thing to say, hey, we made 10% last year as a business. It's another thing to say, hey, we got money in the bank. I mean, that was one of the things that also shocked me is every now and then you go, oh man, we just had to pay our workers' comp premium and it went up 20 grand this year because we got a bunch of new employees. And so we weren't expecting to have to spend another 20 or $30,000. So cash flow is one thing. Looking good on paper is maybe another. So what are some things, give me some advice. Let's say 6 months from now, I'm going to call you and I'm going to say, hey, Jordan, I'm getting ready to expand my business. I'm going to go buy one of my competitors. So I've got to get my business financial house in order. What are the top 2 or 3 things that you think? So personal expenses, it sounds like, is a big one. What else do you see that maybe heating and air companies are screwing up?
Yeah, I think that there's a side to any loan approval is tied to the business, and that's going to be the basis of the loan approval. It's the first thing I've got to get to make work is the numbers. Got to make sure the cash flow can support whatever the loan is I'm giving you. So that's always where we start. So I always start with the organized financial side. But another big thing is the personal credit side. As a rule of thumb, I mean, the SBA loan program, they'll let you get pretty aggressive on credit. But we as a lender, we look for a 680 credit score as a rule of thumb. Other banks are going to be different. But we're telling people, hey, if you're 6 to 12 months out, make sure your financials are organized. Make sure you're keeping a close watch on your credit. You're not showing any past dues. You're not letting stuff go to collections and things like that. Because we have to hit that number too to get it approved. And for both of those things, if you can show the easiest picture, not only does it help your chances of approval, but it helps really streamline the process too. If you're sending it to me and I'm having to pick through what the true cash flow is and having to pick through what potential add backs are, having to look through your credit and have you call these people because you weren't thinking about it before, it takes a 2-week approval to a 4-week approval. And we all know time is always of the essence. So I would say those are the two big things that can really hold up an approval or hold up a closing. It's going to be organized financials, personal credit side.
Okay. Gotcha. Nice. Mary, at the end of this podcast, I'm going to ask you to co-sign a loan for me. So is there any other questions you can think of between now and the end?
I think we have to have some more personal conversation. But that's hilarious. I guess maybe it was interesting to hear you talk about that experience, Stephen, because here's a little compliment for you. I consider you very savvy, and to hear that whole that bit was kind of shocking. I agree with you. Like that would kind of throw me off again as someone who, like you said, pretty running the business, fiscally conservative, and being smart in that way. But it made me curious for you, Jordan, if there's anything that shocks you, like now that you've been in the business for a little bit of time and what you see with different kinds of contractors.
Have you guys ever heard that? I mean, you hear about it a lot in the residential side. You hear about the person who's 3 days from closing and they decide to go take out that $1,000 monthly payment on the new Audi.
Yeah.
You guys heard that story?
And it's always an Audi or like something
Lexus.
Nice.
There's something like brand new F-250. It's the same thing, and it's the same thing in business lending. I mean, I can't tell you guys how many times I'm trying to do a loan for somebody and we're a week before closing and they're like, hey, Jordan, my wife wants to buy a new car. She wants to take out $1,000 monthly payment. What do you think? I'm like, gosh, can we just wait a couple days? I mean, maybe not do that. So you hear that a lot. I think one of the biggest things that I feel like I see that negatively impacts a contractor, and I guess you can say negatively impacts one person, positively impacts the other. So if I've got an existing heating and air company that's looking to buy another company, they'll go under LOI, they'll go under purchase agreement, and it'll just be a matter of collecting the documentation you need to close that loan. Well, the seller in that situation, they count their chickens before they hatch. They stop running the business like they're going to keep it for a while, stop running jobs, stop running their marketing plan, and sales go from what they thought was going to be X down to here at X. And now you get 2 weeks from a closing and the underwriter's making sure everything's in line, and that purchase price you thought you were getting, bank can't do that anymore because you stopped running your business and they want to make sure it's going to continue performing. So that's always a tough conversation to have, but I kind of view that twofold, right? For our customer, typically our customer is the person buying the business. And if I'm giving Steven a loan to go buy another business and I take a look at these numbers and I'm like, hey, Steven, the business went from X to X. I don't want to give you this loan right now because if I do, you're going to be struggling to make the loan payment right off the bat. It's almost protecting the interest of Steven, but it's terrible for the seller because they thought they were already on vacation. They thought they were getting X amount, and now we can't close the loan because the business isn't performing the same. So that's a big. I hate when that happens, but it does happen a ton. And I would say that's probably, I see it very often. That's probably one of the toughest things to see. But I try to think about it from the other side as I'm protecting Steven in that situation by not layering on debt that he can't support.
Yeah. I think the reason personally, having gone through a home purchase myself, it's kind of like one of the first times that you are seeing like, wow, I can do a lot with money that I didn't really ever hold physically. And I think that's the same thing with maybe business lending. Like all of a sudden now we're talking about bringing in some working capital, and it just the mind loves to shop, whether you're indifferent to actual shopping or not.
Yeah.
Like all of a sudden, like that kind of that wanting kind of appears, and we see people do things like reach for the F-250. So, but at the end of the day, what lending does and what financing and however you say it does is give you access to working capital, and that is so critically important, especially when you're talking about doing any of these kinds of activities that we've discussed today. So really love that we have a partnership with Live Oak Bank to be able to open up that opportunity. Because my last question is, how do you go about finding a good business lending partner, and what should a business be looking for? Obviously, the fee structure you mentioned, probably should be looking into that. What would you recommend?
Yeah, so I think it's always helpful working with somebody who understands the business lending side. I think what you have to be careful about is a lot of folks claim to be an SBA lender, and to give you the long-winded answer, the SBA has a preferred lender program, and essentially they will designate certain lenders as a preferred lender that can do loans on behalf of the SBA, so they don't have to bounce back and forth with the SBA on if they can do a deal or not. And the process with that lender is typically going to be a lot more streamlined than the process with a lender who is not a preferred lender with the SBA. Because even if you're not a preferred lender with the SBA, you can still process an SBA loan. But what happens is they have to go back and forth with the SBA every step of the process to make sure they're adhering by the correct rules and procedures. So what I always advise people is if this is a situation, or if you find yourself in a situation wanting to look into an SBA loan, make sure you're working with somebody who does these types of loans frequently. Don't just lean on your local bank if they don't do a ton of them, because that process that would take you 60 days typically, now it's taking you 6 to 12 months. That's the biggest piece of advice that I have. The second is thinking about working capital. So a lot of folks, and it's huge in our industry, a lot of folks are looking for working capital to bridge a seasonality gap. And what oftentimes happens is they see an ad on QuickBooks that says, hey, I'll give you a 1-year loan at 30%, but they can get you the money in 2 days. I try to steer people clear of that, because a 1-year repayment term on a loan that's at 30%, it might not help you as much with your seasonality as you thought, because you're having to front a pretty high payment. So I would say with the SBA program, there are lenders that can get those type of working capital deals done in about 2 to 3 weeks. Yes, you can't get the money right away, but it's on a full 10-year term. So you have a longer payback period. There's no prepayment penalties if you decide you want to pay it back at the end of your slow season. And then the interest rates are going to be a lot better for you than that short-term loan that you might see. So I would just recommend people look into your options, talk to a preferred SBA lender before you make any rash decisions on where you're getting your financing from.
Yeah, I love that. That makes a lot of sense.
One last thing, I think, we ran into, here's something we ran into, which was one, during COVID, it was hard to buy vehicles. So we had trouble buying vehicles. And then two, for the last 15 years, it's been hard to hire employees. So one of the things we did was we just said, hey, if it's a small heating and air, small plumbing, small electrical company, let's say under 8 employees, we would just try to buy up some of those small companies. One, because we could get their vehicles during COVID. And then two, we found some really good employees. And one of the things we would do would be, we use Service Titan. So we would set up a marketing campaign. If I'm buying Mary's company that's got 3 employees and does $500,000 a year in total revenue, I could set up a marketing campaign called Mary's Heating and Air in Service Titan, tie her phone number to that, and then just pay Mary commission off of every job that comes in off that number. And we were pretty successful at doing that because the owner usually only did one trade, but we would pay commission off of any trade that we did work to one of the customers at that house. So sometimes we could take a customer base that was doing 500,000 a year and turn it into a customer base doing 800,000 a year. Yep. And pay Mary 10% commission for several years or something like that, 3 to 5 years usually. The downside to that for the owner is that, one, they're relying on us to be honest and ethical, but we could just print a report in Service Titan and show the revenue and track the phone numbers. So that made it easy. But two, we didn't have to dig through the owner's financials. And those small companies, that's where it was just really a nightmare to go, what is this business worth? Because the owner could say, I did $250,000 last year in total revenue and 200,000 that's profit, but there's no way, you can't prove that. So it just was insane. But if we had the chance to buy a little bit bigger company, that SBA vehicle, like I said, we bought an electrical company that way, and it came with the real estate. That was a really nice way to finance that for a long term, even though we paid it off a lot quicker. It did get that monthly payment down low where we could afford that during the seasonality of the business where we didn't have tons of cash. So
you were there's a lot of creative ideas. I've seen that one a couple of times with the smaller deals too. I think whenever you get into the situation of maybe call it closer, maybe the $300,000, $500,000 roughly in sales company, you can get creative with solutions like that make sense to all parties. What we see a lot is, call it the $2 million company, that maybe the business is valued a little bit more and they don't want to take the risk of holding back that note. They want to be paid at closing. That's where we see the SBA loan be a big benefit there. So there's a lot of creative ways to get a deal done. So that's a common one that I see that works well for people.
I think people, private equity has been buying up companies all over the place, but only from a certain size on up. And the folks under that certain size, sometimes they're like, what do I do with my business? How am I going to be able to retire or sell? And I only have 4 employees and none of them are really going to be able to buy this business. What do I do? So that was kind of our market. It was like, hey, maybe we could pick up a few of these here or there and get some good employees and get some vehicles and get a customer base. So
that's another good point for the person who's listening to this, that's maybe thinking about retiring or thinking about getting out of the business, and maybe they've got a person in that company that's helped them grow it. So general manager, if you've got a second generation, third generation person that you'd like to transition it to, a lot of folks don't realize that there's an option for them to sell out to that person. I talk to owners all the time. They're like, I want $1 million for my company. I'm like, have you talked to your son who's pretty much running the business for you? Or have you talked to your GM who's helped you grow? And they're like, they don't have the money for it. That's a big way that the SBA can help folks too, is help provide access to financing for that first time buyer so that the owner gets their money at closing, they can retire. But then you've got the new owner that's in that seat that's hungry to grow too.
I heard a statistic, and I don't know, this is a few years ago, so I don't know if the statistic's still true, but something like 70% of owner finance deals fall through. So when it's the owner financing the sale of the company, the likelihood that he ends up having to reclaim that business because whoever bought it couldn't make the payments is pretty high versus like, hey, if you actually jump through the hoops and SBA, you can make it through the SBA underwriting, the likelihood of that being successful is so much higher. So that was that. Hey, I got that statistic from a business broker. So he hated owner finance deals.
It's I could see that. I don't know the exact play on it, but if you're the seller and you're out in Hawaii drinking pina coladas on the beach and you get a call from the person you sold to, like, hey, I can't make the payment anymore, you got to get back in the business and try to sell it to somebody else, unfortunately. So it's really risky.
Yeah.
Never count your pina coladas before they hatch, right? Isn't that how that saying goes?
Exactly.
Well, this has been really informative for me. I knew a little bit about this area, but not in this much detail. So, Stephen, great suggestion. Did you have any last questions before we wrap it up?
I got a non-compete in heating and air, plumbing and electrical, Mary, but I feel like we should, if you could co-sign for me, we could buy a business. We could go, Jordan would hook us up. We'd go find something else. And then we'll just do a new podcast about that. That's what we'll do.
We might have the same non-compete. That makes sense. Okay. Well, I love it. Jordan, how can we find you? How can customers reach out to you?
Give me a call on my cell phone. My number's 910-358-4588. Easiest way to get in contact with me. That's the direct line. You don't have to talk to a robot. You can call me straight. And then my email address is my first dot last name at liveoak.bank. So
perfect. Okay.
Any way I can help, I'm happy to help.
Jordan.Cordero at liveoakbank.com.
Liveoak.bank.
Oh, liveoak.bank. Okay. Jordan.Cordero.
They get a little tricky.
Okay. Jordan.Cordero at liveoak.bank.
You got it.
Got it. Well, that's almost as fun as our email address. Hopefully listeners know that you can reach us at HVAC_full_blast at traintechnologies.com. And as always, we're really interested to hear from you and get your feedback on what you like and what you'd like to hear about. But with that, Jordan, thank you so much for joining us.
Yeah, I appreciate you guys having me. I had a great time.
Always.
Thanks.
Catch you later, and thanks for listening.